School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 4 Financial Statement Analysis, Unit 12 Understanding Annual Reports.
After completing this unit, you should be able to develop abilities to navigate annual reports, know the important contents in an annual report, learn about the qualitative and quantitative aspects of the company, and analyze and understand the financial statements. Introduction. In Unit 12, which is Understanding Annual Report, we will look at a company's annual report and understand some of the important facets of this document. The objective of this chapter is to help you develop your abilities to navigate annual reports. Annual report is a report that is prepared yearly. It contains information about the firm's business and its financial position and performance. The students can navigate through the annual report to learn about the qualitative aspects with respect to the firm. Various stakeholders like investors, analysts, suppliers, customers, and employees use the annual report to facilitate decision-making in areas such as investments, credit granting, and establishing customer-supplier relationship. This unit will provide you with the skills to navigate annual reports with ease and find the relevant topics of your interest. To begin with, what is an annual report? An annual report is a document that publicly traded or listed companies must provide annually to shareholders. It describes the company's operations and financial performance or position in a detailed manner. Apart from this, it contains images and graphics coupled with an accompanying narrative, all of which highlight the company's activities over the past year. The annual report may also provide information regarding the company's forecast. Contents of annual report. Let's understand the contents of an annual report. There are 4 broad contents of an annual report, namely, Number 1, non-audited information. Number 2, financial statement. Number 3, notes to the accounts. And number 4, accounting policies. Non-audited information. The non-audited information is further classified into narrative items and non-narrative items. Narrative items. With the narrative items in the annual report, there are some of the important statements like Chairman's Statement, Director's Report, Operating and Financial Review, Statement of Corporate Governance, Auditor's Report, Statement of Director's Responsibilities, Sustainability Report, and Management Discussion and Analysis. Now let's discuss all of these in detail. Chairman's Statement. Chairman's Statement highlights corporate activities, strategies, researches, labor relations, main achievements, focuses on future goals and growth. In corporate annual report, the chairman's statement may or may not always be found, but may be provided to shareholders as a separate document. Chairman's statement may concentrate on economic condition of the industry to which the corporate unit belongs and the economy of the country. It also provides an overview of the trading year, a personalized overview of the company's performance over the past year, and usually covers strategy, financial performance, and future prospects. Director's Report. Its principal objective is to supplement the financial information with other information considered necessary for a full appreciation of the company's activities. It includes, number 1, a description of the principal activities of the company. Number 2, a fair review of the current and future prospects of the business. Number 3, information on the sale, purchase, or valuation of assets and recommended dividends. Number 4, employee statistics. Number 5, names of directors and their interest. And number 6, details of political or charitable donations. Operating and financial review. This is a statement in the annual report which provides a formalized, structured explanation of financial performance. The operating review covers items such as operating results, profit, and dividend. The financial review discusses items such as capital structure and treasury policy. Statement of corporate governance. Statement of corporate governance includes a statement of corporate governance procedures and compliance, information on board composition, statements on the company's performance, and information about compliance and conformance with best practices for good corporate governance. Corporate governance focuses on a company's structure and processes to ensure transparent and responsible corporate behavior. Corporate governance is a dynamic process. Effective corporate governance not only reduces the agency cost incurred due to division of ownership, but it helps in saving of time and resources of investors. On one hand, poor corporate governance practices enhance the agency cost and reduce firm valuation, whereas on the other, good corporate governance facilitates independent supervision of company's management and encourages effective decision making, which enhances firm value, reputation, credit rating, improves overall performance, lowers cost of capital, improves access to capital markets, and increases competitive edge. Auditor's report. The independent and external audit report is typically published with the company's annual report. The auditor's report is important because banks and creditors require an audit of a company's financial statements before lending to them. The auditors shall make a report to the members of the company. It is the obligatory duty of the directors to get the accounts of company audited every year by qualified auditors. An auditor is appointed by the shareholders of a company to audit accounts, and as such, auditor addresses the report to the shareholders of the company on the accounts audited by him. It is the duty of the board of directors to attach the auditor's report to the balance sheet so as to provide a copy of auditor's report to every member of the company. Statement of directors' responsibilities. It is an important statement in the annual report and is prepared in accordance with the section 135(5) of the Companies Act 2013. Sustainability report. A sustainability report is a report published by a company about the economic, environmental, and social impacts caused by its everyday activities. A sustainability report is the key platform for communicating sustainability performance and impacts, whether positive or negative. Apart from the broader overview of sustainability, the SEBI, that is Securities and Exchange Board of India, has developed new norms, voluntary from 2019-20 and mandatory thereafter, which would apply to the top 1,000 listed entities. The SEBI reporting norms on business responsibility follow the national guidelines on responsible business conduct put forth by the Ministry of Corporate Affairs. The norms require that businesses conduct themselves with integrity and transparency, provide goods and services in a safe, sustainable manner, and respect the interest of all their stakeholders, which is unexceptionable. The new requirements include disclosure on redressal procedures for complaints and grievances, including on those pending resolution, R&D spends on better environmental and social outcomes, employee skill levels, including of those differently abled, and provision for insurance, maternity, paternity, and daycare facilities. But also required now are routine disclosures upfront of energy consumed to turnover, ditto for water, and more generally, the percentage of recycled or reused input materials to total raw material usage by value is also to be revealed. Gender diversity should get more attention in the reporting and a board committee rather than just a board member should be accountable for ESG reporting. Businesses are, of course, accountable to their shareholders, but increasingly, consumers, employees, and investors also seek sustainability, social responsibility, and good governance in corporate performance. ESG, short for environmental, social, and governance, is quite the rage among large investors. That means that companies must disclose their governance processes, social practices, and environmental impacts. That is what SEBI wants. Management discussion and analysis. This section is perhaps one of the most important sections in the whole of annual report. The most standard way for any company to start this section is by talking about the macro trends in the economy. They discuss the overall economic activity of the country and the business sentiment across the corporate world. If the company has high exposure to exports, they even talk about global economic and business sentiment. Following this, the companies usually talk about industry trends and what they expect for the year ahead. This is an important section as we can understand what the company perceives as threats and opportunities in the industry. Remember, until this point, the discussion in the management discussion and analysis is broad-based and generic. That is, global economy, domestic economy, and industry trends. However, in the future, the company would discuss various aspects related to its business. It talks about how the business had performed across various divisions, how it fares compared to the previous year, etc. Non-narrative items. Within non-narrative items in the annual report are financial highlights, highlights of the year, and shareholder information. Financial highlights. Financial highlights include year-on-year comparison of revenue from operations, EBITDA, that is, earnings before interest, tax, depreciation, and amortization, ROE, that is, return on equity, and PAT, that is, profit after tax for the financial year. Highlights of the year. It includes other than financial highlights, for instance, launching new products, brands, opening new showrooms, and the like. Financial statements. There are 3 financial statements discussed in the annual report, namely balance sheet, profit and loss account, and cash flow statement. Balance sheet. A balance sheet is a statement of the resources owned and controlled by a business at a single point in time. It gives a snapshot of assets, liabilities, and capital at a point in time. It provides information about the company's funds and how they are used in the business. Balance sheet, which is also known as position statement, provides a bird's eye view on company's financial position as well as condition. This statement indicates whatever company has and whatever company owes. The excess of assets over liabilities is known as owner's equity or shareholders' funds. Profit and loss account. The profit and loss account is a statement which shows total business revenue less expenses. The profit and loss account quantifies and explains the gains or losses of the company over the period of time bounded by 2 balance sheets. It provides a summary of the year's trading activities, revenue from sales turnover, business cost, and profit or loss. The profit and loss account, which is also known as income statement, indicates net profits earned by the company during current financial year. Income statement also indicates profits available for distribution and appropriation after meeting tax liabilities. Profit and loss appropriation account or retained earnings account is also submitted with profit and loss account, which indicates appropriations made during the period. Cash flow statement. This is a statement which shows the flow of cash into and out of the business. It is not the same as a profit and loss account. The cash flow statement only records movement of cash. For example, it does not include credit sales or purchases until such time as cash actually flows. This statement becomes mandatory because of some high-profile business failures of the 1980s and 90s. These were companies that in terms of the profit and loss account were profitable but were short of cash to pay their debts. The cash flow statement should not be confused with a cash flow forecast. The former is historical, whereas the latter is forecast about the future. Notes to the accounts. It provides a more detailed analysis of some of the entries in the accounts, including number 1. Disclosure of accounting policies used, for example, depreciation and any changes to these policies. Number 2. Inventories. Number 3. Sources of turnover from different product segments. Number 4. Details of fixed assets and share capital. Number 5. Directors' emoluments, that is, how much the directors earned. And number 6. Earnings per share. In this part, we will go through some of the important notes to the accounts, sourcing the same from Titan Company's Annual Report 2019-20. Depreciation. Depreciable amount for assets is the cost of an asset or other substituted for cost less its estimated residual value. Depreciation is calculated on the basis of the estimated useful lives using the straight line method and is generally recognized in the statement of consolidated profit and loss. Depreciation for assets purchased or sold during the year is proportionately charged from or up to the date of disposal. Freehold land is not depreciated. Inventories. Inventories other than quantities of gold for which the price is yet to be determined with the suppliers or unfixed gold are stated at the lower cost and net realizable value determined on an item by item basis. Cost is determined as number 1. Gold is valued on first in first out basis. Number 2. Stores and spares, loose tools and raw materials are valued on a moving weighted average rate. Number 3. Work in progress and finished goods other than gold are valued on full absorption cost method based on the moving average cost of production. And number 4. Traded goods are valued on a moving weighted average rate or cost of purchases. Cost comprises all cost of purchase including duties and taxes other than those subsequently recoverable by the group, freight inwards and other expenditure directly attributable to acquisition. Work in progress and finished goods include appropriate proportion of overheads and where applicable other taxes. Unfixed gold is valued at the provisional gold price prevailing on the date of delivery of gold. Net realizable value represents the estimated selling price for inventories less estimated cost of completion and cost necessary to make the sale. Revenue from operations. In this note, sources of revenue from different product segments like watches, jewelry, eyewear, and others are stated. Details of fixed assets and share capital. Fixed assets. Land and buildings held for use in the production or supply of goods or services or for administrative purposes are stated at cost less accumulated depreciation and accumulated impairment losses. Freehold land is not depreciated. Property, plant and equipment are carried at cost less accumulated depreciation and impairment losses if any. The cost of property, plant and equipment comprises its purchase price or acquisition cost, net of any trade discounts and rebates, any import duties and other taxes other than those subsequently recoverable from the tax authorities, any directly attributable expenditure on making the asset ready for its intended use, other incidental expenses and interest on borrowings attributable to acquisition of qualifying property, plant and equipment up to the date the asset is ready for its intended use. Machine spare parts are recognized in accordance with this INDAS, that is Indian Accounting Standard, when they meet the definition of property, plant and equipment. Otherwise, such items are classified as inventory. Subsequent expenditure on property, plant and equipment after its purchase or completion is capitalized only if such expenditure results in an increase in the future benefits from such asset beyond its previously assessed standard of performance. The estimated useful life of the tangible assets and the useful life are reviewed at the end of each financial year, and the depreciation period is revised to reflect the changed pattern, if any. An item of property, plant, and equipment is de-recognized upon disposal or when no future economic benefits are expected to arise from the continued use of the asset. Any gain or loss arising on the disposal or retirement of an item of property, plant, and equipment is determined as the difference between the sales proceeds and the carrying amount of the asset and is recognized in the statement of consolidated profit and loss. Share capital. The share capital is categorized into two types, namely authorized share capital and issued share capital. So what is the difference between the two? Authorized share capital is the maximum extent of funding that can be raised through the issue of shares. It is laid out in the company's charter documents. Issued and paid up share capital is the part of authorized share capital against which shares have been issued to shareholders of a company against full payment. Directors' emoluments. The information required under Section 197 of the Act with Rule 5.1 of the Company's Appointment and Remuneration of Managerial Personnel Rules 2014 is given by the company. The ratio of the remuneration of each director to the median remuneration of the employees of the company and the percentage increase in remuneration of each director, managing director, chief financial officer, and company secretary in the financial year is disclosed by the company. Earnings per share. Basic earnings per share or EPS is computed by dividing the net profit attributable to the equity shareholders by the weighted average number of equity shares outstanding during the year. Diluted earnings per share is computed by dividing the net profit by the weighted average number of equity shares considered for deriving basic earnings per share and also the weighted average number of equity shares that could have been issued upon conversion of all dilutive potential equity shares. Dilutive potential equity shares are deemed converted as of the beginning of the year unless issued at a later date. In computing diluted earnings per share, only potential equity shares that are dilutive and that either reduces earnings per share or increases loss per share are included. Accounting policies. The companies must describe the accounting policies they use in preparing the financial statements. Companies have a choice of accounting policies in many areas such as foreign currencies, goodwill, pensions, sales, and stocks. As different accounting policies will result in different figures, it is necessary to state the policy that was used so that the readers of the accounts can make an informed judgment about performance. It is also important to state the effect of any changes in accounting policies, restating prior year numbers where this is materially significant. Difference between annual reports of public company and private company. There are three main differences. Number 1. In case of private companies, the annual report is prepared following Section 134 and other applicable provisions of Companies Act 2013. Whereas for public companies, the annual report is prepared following the aforementioned as well as Regulations 32, 34 and Schedule 5 of SEBI's LODR, that is Listing Obligations and Disclosure Requirements Regulations. Number 2. The annual report for a private company, one whose stock isn't traded on the open market, is usually a document that gives users just the mandatory information about how the company performed in the past year. That's because most private companies are closely held. They have a small number of owners. So they are not too concerned about how a larger audience will react to the report. On the other hand, a public company's report is often loaded with bells and whistles such as marketing material designed to tout the company to potential investors and creditors. And thirdly, the annual report for a private company doesn't always have its financial statements audited, while public companies do. A private company usually has its financial statements audited only if doing so is required to fulfill a business purpose. Annual report for a government company. Where the central government is a member of a government company, the central government shall cause an annual report on the working and affairs of that company to be, number 1, prepared within 3 months of its annual general meeting, before which the comments given by the Controller and Auditor General of India and the audit report is placed under the provision to subsection 6 of section 143, and number 2, as soon as may be after such preparation, laid before both houses of parliament together with a copy of the audit report and comments upon or supplement to the audit report made by the Controller and Auditor General of India. Where in addition to the central government, any state government is also a member of a government company, that state government shall cause a copy of the annual report prepared under subsection 1 to be laid before the house or both houses of the state legislature together with a copy of the audit report and the comments upon or supplement to the audit report referred to in subsection 1. Green Annual Report. Just like the normal annual report, a green annual report is a comprehensive document that contains information on a company's financial position and performance over the preceding year. The major difference between a normal annual report and a green annual report is that the latter is printed using production processes that save energy, trees, and water, as well as reduce waste and greenhouse gases. According to a 2005 survey that studied trends in annual reporting, the average number of pages in an annual report was 65, and the number of copies produced averaged between more than 5,000 to less than 50,000. Green annual reports are frequently printed using eco-friendly soy inks. In comparison with traditional petroleum-based ink, soy inks are environmentally friendlier, are available in brighter colors, and make it easier to recycle paper. An eco-audit statement is placed in the final document that estimates the number of trees preserved, pounds of waterborne waste that was not created, number of gallons of water waste flow saved, pounds of solid waste not generated, net pounds of greenhouse gases prevented, and the amount of energy in million BTUs not consumed. Now let's summarize the unit. The annual report or AR of a company is a comprehensive report on a company's activities throughout the preceding year, intended to give shareholders and other interested people information about the company's activities and financial performance. The AR is the best source to avail company information, and hence the investors should choose AR to procure any data related to the company. The annual report contains broadly 4 sections, namely non-audited information, financial statement, notes to the accounts, and accounting policies. The AR contains 3 financial statements: profit and loss account, balance sheet, and cash flow statement. The standalone statement is made of the financial numbers of only the company into consideration, whereas the consolidated numbers reflect the company and its subsidiaries' financial data. The AR is also the best source to get information related to the qualitative as well as quantitative aspects of the company. The management discussion and analysis sections in the AR has the management's perspective on the country's overall economy, their outlook on the industry they operate in for the year gone by, what went right and what went wrong, and what they foresee for the year ahead. Comparing the annual reports of the public company and private company, there are three main differences. Number 1. In case of private companies, the annual report is prepared following Section 134 and other applicable provisions of the Companies Act 2013. Whereas for public companies, the annual report is prepared following the aforementioned as well as Regulations 32, 34 and Schedule 5 of SEBI's LODR regulations. Number 2. The annual report for a private company is usually a document that gives users just the mandatory information about how the company performed in the past year. Whereas the public company's annual report is often loaded with bells and whistles such as marketing material designed to tout the company to potential investors and creditors. And number 3, the annual report for a private company doesn't always have its financial statements audited while public companies do. Green annual report is another interesting aspect to study. It is just like the normal annual report but is printed using production processes that save energy, trees and water as well as reduce waste and greenhouse gases.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.